So I'm Emmanuel Hulmeau, I'm the director of IHES in France, Institut des Hautes Études Scientifiques. And before introducing our speaker, I would like to thank AXA for welcoming us tonight. And I'm really honored that CEO Mark Pearson was able to join us in person. Thanks a lot. So I would also like to warmly thank the American friends of IHES and for organizing this event tonight, and special thanks to Raphael. And for those of you who are attending an IHES event for the first time, allow me to say a few words about our institutions. So IHES is a research institute dedicated mainly to mathematics and theoretical physics. And from the beginning, the institute has been devoted to the international community of scholars with a small permanent faculty of outstanding talent. So one figure gives a good idea of IHES' position in the academic landscape. Out of 10 mathematicians recruited as permanent professors, 7 have been awarded the Fields Medal. So each year, we welcome an average of 200 visitors from all around the world for research visits. They come to the institution for the unique atmosphere of scientific emulation, curiosity-driven discussion, and freedom of research. So genius belonging to no nation and IHES forms together with all the institutes of basic research in mathematics and theoretical physics a worldwide chain of knowledge dedicated to the development of human understanding at its most complex. IHES has very strong links with the US. In fact, the founding director, Léon Motchan, modeled the institute after the Institute for Advanced Study and developed strong scientific connection with its academic community. For example, Oppenheimer was a member of the Scientific Council of IHES at the beginning for several years. And for over 50 years, IHES has remained close to its American friends and enjoyed many exchanges of scientists, all extremely fruitful for the development of scientific research in France and in the United States. Today, American remains from far the #1 nationality housed at IHES for research visits. Now, allow me to introduce a great American scientist, Dr. Robert Frey. And so after 25 years as an applied mathematician in industry, maybe after 15 years spent in quantitative finance as managing director in some well-known hedge fund, you decide to retire in 2004 and embark on an academic career at Stony Brook. So his work focused on risk management, modeling the process of managing complex and dynamical portfolios. And tonight, he will present his analysis of 175 years of market drawdowns. And then maybe Michael Douglas, chairman of Friends of IHES and a great physicist who also works in finance, will moderate some questions and answer a small debate before we invite you to join us for refreshment at the reception. I will be happy to meet you and tell you more about IHES, and Mike and Robert. Again, my warmest thanks for joining us tonight.
Thank you. Well, I want to thank IHES for inviting me and saying some, and for wildly exaggerating my capabilities, but I appreciate it. And I also want to thank AXA for hosting the event tonight. What I want to talk about is, actually, I originally said 175 years, but it ended up being 180 years of market drawdowns. And, I think the process of drawdowns, I think there's really several points I want to make tonight. One is that, when we look at financial markets, we have a tendency to be very myopic in our focus. We calibrate our models over short periods of time. We estimate risks based on what's happened over the last 5 or 10 years. and we think that's a long-term view of things. But in fact, financial markets evolve and change over time scales that are probably much longer than a human lifetime. So you have to look over as long a period as possible to really gain insight. Now again, the argument often is that, well, that's sort of irrelevant, that we're dealing with, if you're looking at the 1800s, you didn't have a central bank. Really, you didn't really have a central bank. You had that was the early, when I start here, it's really pre-industrial revolution. Now we're looking at the modern age. It's we have high frequency trading. We have central bank. We have all sorts of interventions in the market. But I'm going to show here that at least in one important measure, the market hasn't changed much in those 180 years. And it's a measure that's, I think, very relevant from a risk point of view. It's looking at, a maximum drawdown. Okay. Right, so just a quick bio. I worked where I started as a scientist in the defense industry. I worked as a systems engineer and a program manager. Got my PhD in applied mathematics at Stony Brook University. And I was recruited into Morgan Stanley's automated, their pairs trading group in the mid-'80s. When that looked like it was a little shaky, I started my own firm in 1989, and I was recruited. That was acquired by Kepler, by Renaissance. That firm Kepler was acquired by Renaissance in 1992 because I had started Kepler as I was a partner with Jim Simons, and then Jim suggested that we merge the firms in 1992. It was one of the best things I ever did. I was a managing director with Renaissance. I developed the Nova and Econometric funds, which were basically, Nova was essentially a stat-off fund, and Econometrics was a longer-term analysis fund. And then, I retired from Renaissance in 2004. I was the advisory board chair of the University of Chicago's program on financial mathematics, and I'm founder founder and originally director, but now co-director because we just hired Raphael Dudet. He's going to be my boss now, so I'm very happy about that because I can get a little rest and he can take over and I think bring the department to new heights. We're really fortunate. We're very fortunate to have him. I also run a fund of hedge funds, FQS Capital Investment, which is really an outgrowth of my family office. And as a lot of these things go, I was managing money, and other people asked me to manage money for them, and suddenly we had a company. So, I want to talk a little about sort of myopia, and too often in finance and in life in general, day-to-day details overwhelm us, narrowing our focus. And what I have here is a sort of a little graph, and this was from a blog post I had put up. And what it was looking at a regime shifting model of the S&P 500, and I chose the period 1985 to 2000. This was at the time 2013, because that was sort of the extent of my career at the time. I started in about the mid '80s and went until this was done in 2013. And what you can see is, leading up to the 2008 crash, you can see that there was a period of unusually low volatility. Now, what happens? During periods such as this, obviously people think things are, very steady and calm. Right? We also are dealing with, perhaps an environment where returns tend to be sort of moderate and that sort of thing. But since things are so steady and calm and all the risks are low, what do? We leverage up like crazy in order to get higher levels of return. So just as Hyman Minsky predicted, it's a sort of standard Minskian sort of condition. The market becomes so levered and so unstable that that any little thing then becomes a disaster, and the whole market collapses. And you see in 2008, we saw this. You see these marked increases in volatility. But now the trouble is that for many people, their whole career existed in that little valley that we see. You sort of see. I wish I had a laser pointer. Is there a laser pointer? So you see here, that's almost a 7 or 8 year period. There were a lot of people. Their whole careers were spent in this low volatility regime, and and if you had taken the time to go back and look at markets over a longer period of time. And again, I just chose this period. This isn't even enough time because it excludes things like the Great Depression and many other things. But you can see here that this sort of low volatility period here obviously was followed by, much more erratic conditions here, but preceding it was a much higher level of sustained volatility, plus these sort of volatility jumps here, and then there was another period of low volatility, and again, there was a peak here. So, on the one hand, people are calibrating Garch models and doing all kinds of crazy things. It's ridiculous. I mean, they're saying that, we're back to a new normal and nothing's going to change again. Where even a moderate historical perspective would have shown that this was a ridiculous idea. Right? We don't do it. We tend to look at these very short time periods. We tend to be inadequate historians. We get too hung up with the mathematics, and we should be better historians. Okay? And there's sort of the last comment here. You don't design a house based on the weather report, right? And that's what many people do with their portfolios. They look at they look at tomorrow's weather forecast and build the house based on what they're going to see. And that's not a very sound way to do anything in life. Okay. So let's talk about market drawdowns. Now, an investment drawdown is the drawdown behavior of a particular investment is an important element in its behavior. What we're going to focus on is a single market, the S&P 500 total return, and total return meaning any dividends reinvested in the index. And we're going to look at the period from 1835 to 2015. And the source for this is Global Financial Data, and they have a sort of a pseudo 2000 S&P 500 for early periods. Okay. So there's some important questions. How can drawdowns be modeled and analyzed? How do we sort of look at these drawdowns? How stable is this aspect of performance over time? And then really, what insights can we develop examining the drawdowns in an important market over an extended period of time? And those are really the three issues I want to address here. And what I've tried to do, I know we have a sort of a mixed audience, so I tried not to avoid technical issues, but I really wanted to focus on mainly the insights that you can gain from looking at this, at the world, from this perspective. So let's talk about cumulative log returns. So we're going to, if I look at the log of the ratio of wealth from one period to the next, right? That's going to be that's my log return. So my cumulative log return is the cumulative sum going out over time. So that's my basic measure. I'm going to look at the cumulative log returns. Now, I want to then define a drawdown state. Now, what a drawdown state is, what I'm simply going to do is, just as I have a cumulative return, I'm going to have a running maximum. So at any point in time, as I go along the cumulative returns, I'm going to record the maximum value. And obviously, if I go through a losing period, that maximum value doesn't change; it just flattens out, right? And so what I do is I get that maximum value. Now the difference between that running maximum and the current cumulative return is the drawdown. Right? So it's fairly simple. Right? So now what I have is so now what I can do is I have these separate epochs, these separate periods. And what I have is I can when I look at this drawdown number, because I don't care when I'm doing better than as I continue to hit new highs, I don't care about that. That's just going to be zero from the drawdown perspective. So in a drawdown state, the way I've sort of defined it, I'm going to have either a period where I'm in this drawdown state, so I'm going to have a continuous period of drawdown observations that are non-zero. And that's going to be interspersed with periods where all of the observations are going to be zero, which represent periods where the market is rising, right? So I'm going to use that fact to partition the drawdown states across time into partitions. And then the drawdown process I'm going to study is I'm going to simply take each subpartition, and I'm going to look at the maximum drawdown that occurs in each partition. And I'm going to look at the duration of time over which that drawdown occurred. And so I have a sequence of observations now which characterize what I call the drawdown process for the particular investment. Right? So it's a fairly simple idea. So this is...
the partition is arbitrary?
No, it's not arbitrary. It's based on the actual behavior. So if it's a contiguous... If the partition is contiguous segments where you're either in a drawdown state or not in a drawdown state. So the partitions arise naturally from the data. They're not constructed, right? So let's look at the full data set from 1835 to 2015. And that's sort of so what we have here is the log index, and this is the and this is the S&P Total Return Index from Global Financial Data. And you can see in here, these little red periods, those are drawdowns, right? These little periods are a drawdown. And you can see, for example, the Great Depression, right? That's kind of a really big one. But, in general, this, as an investment, this looks pretty good. If you're really looking very long term, there's a steady increase over time, and, it looks wonderful. And, it's easy to forget that those little dips that are filled in with red, where you're in drawdown, sometimes are 5-6 years of pain and suffering. We forget that sometimes, and in the case of the Great Depression, much longer. So, but this is the process. Now, what I do now is I simply look at those drawdown processes, and this is what I end up with when I look at that. Right? And so again, this is 180 years of drawdowns. Now, this kind of something surprising here. I mean, when I look at this, I see a fairly steady increase over time. But when I actually pull out and look at the drawdowns are everywhere. I mean, they're all different sizes. There's little tiny drawdowns and little big drawdowns. And in fact, what we'll see is that, what's interesting about this process, and what's maybe relevant from the point of view of an investor, is that you're usually in a drawdown state, even in a very good and positive investment. Now, this is also something. This is what I did is I looked at the drawdown period, which I identified as tau. So that's the length of the period versus the size of the period. Okay, and I just did a linear regression, and these are highly significant. And it basically says that the length of the period is proportional to the size of the drawdown. And I just for the sake of sensitivity testing, what I did is I looked at all of the data, but obviously I have a couple of high leverage points out there. So if I exclude the top 6 outliers, I get the dashed line, which is really pretty close. So you can there's a pretty much, at least from what you can see here, a pretty linear relationship between the length of the drawdown period and the size of the maximum drawdown. I mean, again, it's expressed as a log. Also, I should mention that this was weighted least squares, because it's also pretty obvious that the variability is proportional to the size of the drawdown period. So what I did is the weight is basically was 1 over the length of the period. So I'm assuming that the variability of the drawdown is proportional to the length of the period, right? Which is not an unreasonable thing. So so what we get here, and now again, I have a much fuller analysis here where I do develop analysis of the joint distribution of these two things. But what I'm going to do is I'm just going to concentrate for now on the drawdowns themselves, rather than the length, how deep the size of the maximum drawdowns, and not talk a lot about their lengths. Although there's some interesting work there for that. Because I'm trying to make this as accessible as possible. Now, one of the things that's interesting is that you have the sort of the S&P, and again, stepping back and looking at the cumulative plot of the S&P, we see kind of a fairly steady upward slope. Yeah, sure, there are drawdowns in there, but on the scale of the increases over this period, first of all, the slope is reasonably constant, and the drawdowns again don't, again with the perspective of almost 200 years, don't seem very large. But if you look at things in the small, right, what happens is that you say, okay, what if I pick a random point in time here? What's the probability of a random month being in a drawdown state? Now again, what does this mean? Well, it means that if you're an investor who's been invested in this market for any period of time, what's the likelihood that at any random time you're looking back at a high watermark, that you're under from your point of view, you're underwater? And it turns out that's true 75% of the time. So and I think that surprises most people. Most people, if you asked, about the market, you would say, well, how often am I, how often am I sort of in a state of regret? Right, let's call it that. And the answer is, even with something fairly attractive like the stock market, and again, there's certainly survivor bias here because it's the U.S. stock market, and it's obviously there's an implicit survivor bias. Even in the U.S. stock market, which is probably one of the most successful you're in this drawdown state, this state of regret, 75% of the time. Then I just chose sort of not entirely arbitrary, but a 20% drawdown. Again, it's a log 20%. 20% drawdown as being like an excessive, a large drawdown. And of that 75% about 60% of the time you're in an extreme drawdown, something over that 20%. Right. So what that implies is that you're somewhere around 60 times. Say you're about 40% of the time you're in 45% of the time you're in a really bad situation. You're in a state of significant drawdown. Now again, I think that this is kind of an underappreciated fact. I think when people look at investor behavior and look at the psychology of investing in markets, we tend not to focus on the fact that for a typical investor, even one who has as long as their horizon is over more than a few years, most of the time they're going to be underwater. Even though in the long run they do tend to make money, and this is kind of I think something that's kind of interesting. I don't think it's something. I think it's sort of one motivation for focusing on drawdown as a very important measure, because I think it drives a lot of what people do in markets. Because that insight of because where does regret come from? Because we naturally anchor our viewpoint to our last highest high water mark, and what we're saying is most of the time when we're investing in anything risky, we're in a state of regret, and that puts tremendous stress on an investor. The second thing is that from a simple mathematical view, we know that when you do get a drawdown and your capital base shrinks, you have to it's just a fact of life that you have to do much better when if you've lost 50%, you have to make 100% to get out of that, right? That's right. The losses and gains aren't symmetrical. So being in a drawdown state also creates that stress of having your capital base is shrunk, and the amount of performance you need to get back to even now is much higher. So this whole notion of drawdowns, I think, is we tend to underestimate the stress on investors, and we tend, when we think about investor behavior, we tend not to talk enough about drawdowns, I would say. Okay, so let's just look at that. So this is sort of the standard kind of plot, and it's a log plot, and what I have is the survival function along the abscissa, and the x-axis is the max drawdowns. And here, this is where you would sort of, typically if you have a parallel or a tail, you see sort of a straight line. And I have sort of this gradual curve, and again, based on looking at other financial indices and looking at various subsets, this thing never really settles down. You get this sort of curve, but it never really settles down to zero. So, after looking at this, I was sort of trying to develop, and also, by the way, I'll show shortly that if the returns were normally distributed, the distribution of drawdowns is exponentially distributed. But what we have here is we have actually some quite fat tails. So what I did is that I was trying to develop a max drawdown, and I sort of, again, based on fitting various, looking at these log plots, which is the typical plot that Mandelbrot first introduced to show tails in these distributions. I came up with just basically a gamma exponential mixture, right? So this, I realized after I went to the trouble of solving this, that this is just a variant of the Pareto distribution. It's typically called the Lomax distribution. The only difference is that beta is usually a scale parameter, sigma, that's divided into the variable, but I just kept it in this form. So what I'm saying is that the PDF of when I sort of fit this, the PDF of the max drawdown, and so looking at each epoch, the maximum drawdown I experience in each epoch, the PDF follows this Pareto. This is a Pareto type 4 distribution, basically. All right. So that's its. So what I have here is, this is how it's derived, right? From the. This is a beta distribution, and I'm integrating over an exponential distribution, and I have this PDF and that the CDF. Okay. So when I do that, so now when I'm going to look at the max drawdown distribution, again over this period, I get this Pareto distribution, I get an alpha of 1.8 and I get a beta of 13.7. Okay, and that's a very good fit. That's an excellent fit. I mean, the fit is. I mean, I use the Kramer von Mises generally. That's my preferred test, but this is very close. I mean, it's pretty clear, you know, that this is an excellent fit to the data. And you can see here what I have is the red is the theoretical and the blue is the empirical. Okay. So now I said, well, let me just sort of look at a Gaussian simulation to see what I get with that. So this is just, now again, obviously I looked at a lot of simulations, but this is just one of them. So I just wanted to look at one of them. So there's the same sort of graph showing, you know, and I see the drawdowns. I see a lot of the drawdowns, and notice they're a lot smaller, but I still get, you know, it doesn't look dramatically different. Here's the drawdowns. Now notice in contrast, you know, the drawdowns here are much, they're not as widely distributed. They look more similar to one another, right, than in the real market case. So now when I sort of look at this case of, again, I'm going to do this same sort of division of, you know, what percent of time are you in a drawdown state versus what percentage of time are you in an extreme drawdown state. And what's interesting here is that, you know, for the Gaussian, and this is a typical result, is that you're in fact you're 80% of the time you're in a drawdown state, and of that 80%, about 67% of the time you're in a more than 20% drawdown. Right? So again, you know, even with Gaussian, well-behaved Gaussian distributions, you're dealing with a thing where you're in a state of regret most of the time, right? You're going to bed with, you know, upset stomach because, you know, you've lost money in the market, you're not sure what's going to happen, and that sort of thing. Okay, so, all right. Now the real difference here is that rather than a Pareto distribution, the distribution of max drawdowns follows an exponential distribution. And here you have the theoretical and the observed, right? And it was actually doing that which led me and some theoretical arguments about, you know, sort of the relationship between stable and distributions and well, normal is a stable distribution. Normal distributions and alpha stable distributions, which led me to the idea of looking at mixtures of exponentials. And you can see here that, you know, we have an exponential distribution, and again, this is a very close fit. Obviously, this is the CDFs. The CDFs match each other extremely closely, and you know, and now, so what's nice about this is that we're not characterizing. Now, on one hand, you could say, you know, we're looking at, in some sense, the tails, but we're not characterizing the tails of the drawdown distribution. We're characterizing the entire drawdown distribution. We're looking at the whole thing, and the whole thing follows, let's say, this Lomax distribution. And again, for normal, these things are universally exponentially distributed, which is something much less, much higher tail. Right. Now, so then I said, well, let me fit a type 1 alpha stable distribution to the data. And again, I ran many simulations there, but I'm going to give you a sort of a characteristic one. So, and you can see right away, it doesn't look anything like the real data, right? It doesn't look anything like the real data. And again, this is, you know, you do get an alpha similar. I think it's 1.6. I have that plotted. But look, you see that, you know, and part of the problem is that the alpha. What's interesting is when I fit in a single alpha stable distribution to the data, I get too many large excursions, and that's what causes a lot of the drawdowns, and also sometimes ends the drawdowns. Right? So again, when I look at the drawdowns, you can see here, and also the size of the drawdowns are much higher. Again, I have this simulated same period of time, and whereas the Great Depression hit about again a log drawdown of 1.8 or so, you see here you're hitting much higher distribution, you know, much higher levels with the stable. So stable distribution, at least not a single stable distribution, doesn't really hack it. And I will tell you that, you know, I'm in the process of firming this up, but, you know, it's obviously that the market has some state memory, and that you're dealing with a mixture of such alpha stable processes that are so. But there is also some state memory that gets in here to change this. But so we're saying that just a stable distribution doesn't do very well. However, one thing that's interesting is that again you see the same pattern. 83% of the time you're in a drawdown distribution. 84% you're in a drawdown distribution, and 69% of that time you're in a significant drawdown. And again, this is everything having the same. In this case, the alpha stable was fit using the same. Data, and again, that's the fit. And it turns out though that the alpha stable distribution does fit the Pareto type 4 distribution. It's a 2-parameter version, and it has an alpha of 1.6 and beta, and the beta, and actually the normal form would be the reciprocal. That would be.
Say a little more what you mean by stable.
What? Stable distributions are distributions that when you add them together, you get another stable distribution. So there's a class of distributions developed by Levy that have this property. Now, the Cauchy distribution is an example. The normal distribution is an example. So when you combine these, you actually a Poisson distribution. When you combine that, you get another Poisson distribution. But there's a class of distributions where there's generally no closed form for the PDF, and you have generally infinite variance, and that's generally this alpha stable.
So your point is that just from the data, there's not like one single distribution of possibilities which is happening again and again and again. Something must be changing within the market.
Right, but it's changing in a consistent way across time because when I break this up into pieces, I get the same.
You seem to be getting Levy was a change in sigma.
Yes, exactly. That's what I think it is. And the sigma seems to have persistence. So what I'm really trying is a Levy stable, essentially a hidden Markov model with alpha stable emissions. Basically, that's what I'm looking at. So.
And how persistent is the calculation with time?
Well, I'm going to cover that. But that's a good question, right? And what I tried to do is I tried to make the breakouts sort of meaningful in a sense, because I'm really trying to sort of again think of it as much from the point of view of the history that I'm looking at as anything else. But but again, what's clear is that with the alpha stable distribution does have the drawdown state, which does resemble this Pareto distribution, as is the other case. However, it's also clear that it's a single distribution doesn't capture, actual stock market returns with any real fidelity. I mean, it's just not true.
Is that data is a daily return?
No, I did monthly because I wanted to get as long a period as possible. And daily returns, when you go back 200 years, really don't mean much, really. So,
They don't?
yeah.
No.
Yeah.
What about truncated alpha stable? Because normally truncated the
Right, you mean like a temperate stable? Yeah, I have looked at that, and that's not here. But yeah, that doesn't change things that much. Yeah. Yeah, right. Yeah. So, all right. All right. So let me look at what I want to do is I'm going to first look at the pre-Great Depression. Because remember, let me go back up here. When you look at the original data, you have the Great Depression in there. So, everybody, the maximum hitting about 0.7, the other one. Then you have the Great Depression that goes up to about 1.8. So let's see if we sort of take that period out and look at the period before. And that's a 93-year period. So that's the period prior to the Great Depression. And qualitatively, it doesn't really look different. That once you scale it down, it doesn't really look different than the whole data set. Again, when I look at it from the point of view of fitting the distribution, I get again a very excellent fit. I get an alpha of 1.8 as opposed to 1.65. I guess was the no, it was about 1.8 for the whole thing. I forget, but it doesn't look very different. So the point is that yes, it's clear that there is that a single alpha stable distribution doesn't handle it. It's clear that it's changing over time, but it's also clear that when I look at this pre-Great Depression period, it's changing at time levels that are less than that, and you know, it's changing in the same way. I mean, it looks the same, right? The underlying process looks the same. Right? And again, I have the same thing. I have, again, about 78% of the time you're in a drawdown, and about 60% of the time in what you might consider as a highly significant drawdown. Okay. All right. So that was 93 years, and again, you know, let's look at a post World War II, and I wanted to sort of, you know, we had obviously World War II ended at 46, I guess. So I wanted to give a few years for recovery, so I started 1950 to 2015. So that's 65 years. That's a little bit shorter than the other period. And again, here's the more recent period. And again, this kind of looks, you know, sort of very similar. It doesn't really, things don't really look all that odd. Again, now alpha is a 2.3. And again, if you know, I did some bootstrap estimates. You know, these alpha coefficients are really quite indistinguishable from one another. They're really not that dramatically different. But you know, now again, the significance of an alpha point to being over 2 is there's some significance there. But I had an alpha of 2.3, and again, beta, the what you might think of as a scale parameter is 11. So again, it looks very similar in this period as well. So when I'm looking at these 3 periods, I'm looking at the whole period, and I find, okay, I have a certain behavior, and I find, but I have in the middle of this tremendous distortion, perhaps caused by the Great Depression. And so, you know, what I do is let me take that out, and let me look at the before and after periods separately and see if things look any different. And the answer is, at least from the point of view of drawdown, they don't look different at all. You know, they haven't really changed at all. And again, think about that. You know, we're talking about, you know, a sort of a basic element of market stability. How much does it drop before it comes back again? You know, right? That's a very important, you know, consideration for any investor, for anybody planning investments. And there's no evidence that, you know, it was different in 1840 than it is in 1940 than it is in 2015. Not dramatically so. Now again, you know, what's different? I mean, in 1907, you know, who was it? J.P. Morgan had to organize all of the bankers to put money into the market because there was no central bank, right? Then we had, you know, the Great Depression, which probably because we had a central bank that didn't know what it was doing, we got a Great Depression. Then we have 2008, which is again, you know, but you know, what's interesting is that if you look at all of these interventions and all of the changes in time, at least this aspect of the market, this basic kind of an interesting characteristic of the market hasn't really changed in 200 years, right? Now think about all this other stuff that's changed. We have high frequency trading. We have all sorts of regulations. We have you know, a central bank which, although it's not its official mission, really does consider the stock market stability as part of its mission, although it's not supposed to, right? But there's no evidence that any of that has any effect whatsoever on the behavior of the market, right? The size of the drawdowns, the distribution of the drawdowns, you know, aren't the same. You know, when you look at something like the Great Depression, if I exclude the Great Depression, and then I say how likely is something like the Great Depression to happen? Yes, it's a rare event, but it's not a terribly rare event. It's, you know, it's an event that might happen every couple of lifetimes or something like that. I mean, it's not, you know. So again, I think, you know, there is a consistent behavior in these drawdowns over time. I think that it says something about, you know, markets in terms of how they're driven perhaps by human nature and everything else. And so despite everything that's changed over the last 180 years, this aspect of the market hasn't changed much at all. Okay, so let's look at some comparisons. Again, here's the PDFs of the max drawdowns. So for each drawdown epoch, you know, obviously I took out the pieces that weren't drawdown. So for each drawdown epoch, I took the maximum drawdown and looked at the distribution. And here's the 3 PDFs. One is for the whole period, then for the pre-Great Depression and post, and then the third post-war. They're virtually the same. Here's the here are the CDFs, and again you can see the post-war looks a little bit better. But I'm going to argue that, I mean, somebody might argue, well, isn't that some evidence that things have changed? But you got to remember too, the pre-war I had 97 years of data. Post-war I had 65. Frankly, my experience is the more data you have, the smaller the exponent tends to grow, right? So that the fact that the 1950 to 2015, I think is more likely due to the fact that I had a smaller period of time that the exponent was slightly higher. I don't really, and certainly from any kind of, when I did some bootstrapping, there's really no difference here. So what we have here is a very, we have a critical element of stock market behavior that's constant over a very, very long period of time. All right, so let's compare the drawdown. So again, I think the key here is that the basic character of the max drawdown is reasonably similar across time. Roughly just shy of 2 centuries, right? There's a recent period that does show a slightly lower incidence of larger drawdowns, but again, I think that might be an artifact of like say, the lengths of the intervals I was comparing. When I look at the probability of a larger max drawdown, so I'm looking at the tail of the distribution. When I look at these 3 periods, I'm looking at a 20%, a 40%, an 80%, and I mean, this is a log drawdown, so it goes out to. Goes out. So 1.1 log drawdown of 1.6. The probabilities don't dramatically change. I see. You're going to see significant drawdowns in all cases, and again, obviously, when you look at those extreme events, those are very noisy. I don't, none of this stuff suggests to me that we're dealing with a process that has changed in any fundamental way. And again, so I think that kind of does surprise me, because I did expect to see some effect of the interventions from government and everything else, and I just don't see it. The market in 1890 and the market in 2015 don't look at all different. It just doesn't look. All right. So what are my conclusions here? I want to talk about this. That market as a driver of regret may play a greater role than we realize. I don't think we think in terms of drawdowns, and we understand how, oh yes, we're going to control max drawdown, but I don't think we think about the fact that most of the time an investor is facing a drawdown when they're investing, and that scares the hell out of them, right? So you have that psychological factor is something that you should be considering, right? And whether you're doing theoretical work or practical, you're in the practice of advising an investor, right? The character of the market over the past 180 years, again, doesn't seem to have changed greatly. And again, you could look at any number of other related things. I think I like drawdown because it was such a kind of, to me, it was an important measure. And by the way, it was being driven by some research I was interested in, frankly, managing my own investments. Yes, sir.
Do you control the flows? There have been periods that you have massive flows in and out of certain markets.
True. No, that I control for them. No, but I think those might be explanatory variables that may explain some of that stuff. But it's pretty clear that to the extent that they affected the behavior of the market, it didn't change from one period to the next. Yeah. So at this point, I'm not trying to diagnose anything or trying to go any deeper. For 2 reasons. One is that I do have much more analysis, but I wasn't sure at the level of the audience. And I know there was people at all different levels, and I wanted to talk about something everybody could sort of appreciate. So, but the answer here is that sure, I'm sure obviously flows in and out of the market are going to have a dramatic effect on the volatility and what happens to the market. But there's no evidence that it's different now than 200 years ago.
Yeah, here's the dilemma. One thing which has changed significantly in markets is the size and the distribution of financial losses in systemic events, right? So you would think that somehow risk premia have increased,
right?
And that it should be reflected in the stock market somewhere.
Well, again, if you okay, well let's examine that. But if we just saw that if I look at the recent period and I look at sort of that maximum drawdown in those periods, right? I don't see any difference now today. So some of what you're saying is that in some important way things have not changed. That's what I'm saying. I mean, from the point of view of someone, you're saying, should the risk premium be different? But I don't. Why should it be different? I mean,
Because again, financial losses tend to explode. You see this sort of exponential growth from one crisis to the other.
But well, no. I mean, that was true in the past as well. I mean, that was true in the past.
That's exactly opposite what he's saying. He's saying that parameterization, if you were to do it any sub-period, would change from what it is today.
It doesn't change from what it is.
The property of flat tail distribution.
Right.
And then you always think, hey,
there's always think it's something different now and stuff like that. It's not. It's the same.
After a large deviation, you think that the parameterization has changed. In fact, flat tail data
right.
will require you to update it.
Right, it's the same, and also you talk about sort of things that financial markets being, the world. One of the reasons the Great Depression was because we had become integrated globally, trade-wise, right? Now that we didn't get back to the same level of global integration in terms of cross-border trading until I think it was like the mid or late 50s after the Great Depression. So there's plenty of, I don't know. I mean, you're saying that it has increased. Maybe it's increased from, 10 years ago, but I don't think it, but again, when I stand back and look at this 200-year period, I'm saying that, no, it hasn't increased. It may be in a high state or a low state, but it's been in those states before. That's what I'm saying. Okay, all right. Yes, sir.
In fact, two. One is as follows. If you just, you use about 2,000 data points for this analysis.
Yeah, something like that.
So if you were to take 2,000 daily returns starting from today, going back 8-10 years,
right.
would you roughly see the same picture? In other words, there is a self-similarity on a much smaller scale.
Yes,
so
right.
And the second question, and even if you look at, say, minute-by-minute returns and so forth.
Oh, that I haven't. Although I have access to that, we do have tagged. I didn't look at minute-to-minute.
Yeah,
but I assume I wouldn't be surprised to find it. I wouldn't be surprised to find it. Right. Yeah.
And the
To
second.
answer to also that last point, I know that people compare what the week of trading after 87
Right.
compared to the flash crash within an hour.
Yeah.
And there was, it was surprising how it was similar.
Okay.
Yeah. But
Okay.
the second question is, in some sense, you were alluding to this in the beginning, that we're dealing with a survivorship basis, right? There are
Absolutely.
other stock markets which were simply completely destroyed, like
Absolutely.
Berlin and Tokyo, and in fact, what
Right. I
would
mean, yeah.
happen-
This, and in fact, if you look at my last point there, I said any study such as this suffers from survivor bias. That's my last point. And the fact that we are likely to have probably underestimated our alphas because we don't have a lot of data here, really, frankly. So, yes, I fully admit that. I mean, I'm trying to describe certain things and observe certain things. But yeah, there's some real limitations here, and I think it's important. It's okay to use this stuff as long as you understand those limitations.
Yeah, but what I try to emphasize is perhaps it would be even worse if you were to look at stock markets which then have disappeared for a few years. Like in Tokyo, they had extremely brisk trading between the beginning of the war and 44. It was very, very brisk, and then it was completely destroyed.
The answer is if you look at, and actually I have if you look at the, again, this isn't here, but we can talk about this later. If you look at the stock, because one advantage of global financial data is that I can get this data. If you look at the losers in World War II, yes, they look a lot worse than the winners in World War II. So I've done the same thing, for example, with the English stock market. And even though England was subject to great stress during the war, had bombings in London and stuff like that, you see pretty much the same pattern as you do in the United States. So you don't really see, that doesn't change. But if you do look at some place like, say pre-World War II Germany, right, which is, you look at the fall of the regime, obviously you had, immense hyperinflation, that sort of thing. And if you look at Japan post-World War II, you see the same thing. And what you see is just bigger drawdowns. I mean, yeah, but they're not that different. I mean, you see that I mean, yes, but there is a survivor bias here in the sense that there's no lost war that the United States has experienced during this period. Not really. And if you had one, you would see a much bigger event. Yeah.
Do you know, have there been behavioral economic studies that try to reproduce anything like this?
Well, that's
That is backwards.
Yeah.
The early economics guy,
Yes,
I had
right,
a war
yeah.
with this guy Thaler, who's an entertainer, who's the behavioral economic guys are entertainers. He did the exact opposite of this talk. So if you listen, these guys think that you should invest in the stock market based on myopia, computed out from calcium.
Well, that was not my. I mean, that's amusing, but I'm asking more if people have tried to construct experiments where people form an artificial market. To see
From what I've seen, I mean, obviously, when you read the behavioral literature, this notion of anchoring is a big deal.
Right.
So obviously, people, I think, if you ask the guy, well, what would a person feel in a drawdown state? They'd feel regret. But no, in terms of actually looking at the distribution process, that drawdown process, and saying how it's actually going to influence an investor, no, I haven't seen anything.
Perhaps you could create a.
Well, actually, my argument there is that somebody should. That's not my area of interest, but somebody should really look at that, because I think that market drawdowns, first of all, are more pervasive than we think, and that for most investors, it's going to present a tremendous stressor on an investor. And I don't think people appreciate that. When you look at it. I was saying, let me go down and make a few more points. I just want to say a realistic statistical model awaits in terms of understanding financial markets. We're unable to adequately model returns to reproduce with this. So again, like I said, if I put in an alpha stable, now again, as Nassim said, yeah, you put in a mixture of alpha stables, you do get something that looks a lot more. But again, there seems to be some memory in there. So something like a hidden Markov process, or some state memory that comes in that is important. But right now I don't know how to do it. So I haven't done it yet. I'm going to try and do it. If somebody else wants to do it, they're welcome to do it. But one thing I think is really important to say, it would be a mistake to view the Great Depression as an outlier. Because if one more person tells me that the Great Depression can't happen again, I'm going to have to kill them. They're going to have to. They're dead. I'm going to have to kill them.
They seem to come close recently.
Well, yeah. Well, but the point is that even without the observation of the Great Depression, such a thing is not even an outlier. I mean, we got to stop. We got to look at the reality here. When somebody says, because we've learned so much, I just drives me crazy.
Okay, well, on that note, perhaps we should thank Dr.
All right. Well, no, I think there's some more. Yes, sir.
So I was just wondering if, on this analysis of the program for a very long history, you have noticed some effect of memory in terms of autocorrelation and clustering effect, like this you are coming to.
Well, again,
and
I'm sorry.
The point was also to see that because we know that we have also the history on inflation over a very long period, and then we know that most of the time during the change in inflation, when you change in inflation, we usually have a spike of the change in this period of the market. I was just curious to know if you noticed some correlation between or some causality effect.
Okay. Again, when I was doing this, I wasn't at this stage looking at any cross correlation and that sort of thing. What I have thought about doing is looking at a regime switching model where, again, you have these alpha stable emissions, and the probability distribution you're in any one emission state is controlled by some other exogenous variables like inflation and something like that. So that would give you some of the effects you'll look at. And as a matter of fact, the first dissertation we produced out of Stony Brook, out of the QF program, was just on that topic, on modeling the behavior of hedge funds, where we had basically a hierarchy of model. We had a sort of a bunch of submodels, and which model this strategy sort of behaved like was controlled by certain macro variables, and we used it.
What you're saying is you don't really need regime shifts?
Well, that is a regime shift, though. In other words, that is. I'm not saying I don't know what controls the regime shift. Is it controlled by some exogenous collection of variables and some model that would allow you to generate that, or is it something like a hidden Markov model? I don't know what the meta model is that controls the regime shifts. But I think it's kind of obvious that there is regime shifts here, and they probably are alpha stable or something equivalent. Yeah, I'm sorry.
Yeah. I mean, we're in the world of an insurance company, and I've been very surprised that the way insurance people and finance people approach the question of risk is almost orthogonal. That finance people tend to look at time history, like you did. And insurance people, on the contrary, to look at the cross section of so they would look at the population. And when I was looking at that, I was saying, okay, you're trying to go back very long to make a statistics.
Right.
But in fact, when you look at financial series, you have dozens of different indices.
Right.
You can multiply and you can observe the exact same similarity.
Oh, sure.
When you are doing, I mean, it's sometimes you want to say, if you want to understand what's happening, look at the Chinese market today looks like what it was.
Oh yeah.
The US market post-war, etc. So first of all, I mean, there's a suggestion to do that. Now, to answer your question, which is we are missing an adequate model. What is an adequate model is not such an easy question.
I agree with you.
The question that I'm obsessed with is more like what Daniel was asking. That is, if we can have some measure of temperature that tells us, okay, in here, the probability of a drawdown, of a major drawdown coming is a bit higher than in other times. It's
yes.
like, a weather prediction
right.
that tells you not something is going to happen, but the probability of something happening has risen. And that has a value, also like for an insurance company,
oh, absolutely.
saying, exactly this type of mentality that could be useful not only for investors, but also for regulators, etc.
Yeah, absolutely. And I think that's, I think that's one advantage of having, that's, again, let's talk about that meta model that selects what state is the guy's in. It's much better if you have something that's driven by some other exogenous process that you can examine and use to forecast and predict. Even if you just can observe it in situ and say, okay, this is where we're at, and this is the environment we're in. And obviously, if you look, I mean, the results here, if you looked at the because they're highly correlated, this and the British market, you'd find everything's pretty much the same here.
It's not necessarily exogenous. Precisely the correlations.
Oh no, but
by itself.
Yeah, right.
An
Yes.
indicator.
Yes. Oh, yes.
Of
Sure.
course, there's
yes.
this strong belief that there are financial bubbles, and that the slope of the line is larger before the major.
Well, the thing is, though, that, what's interesting here, though, is that these drawdown behaviors, which include the effect of financial bubbles, remember, I wasn't just modeling the big financial drawdowns. I was modeling all of them, right? And the whole distribution fit very well, right? Because most when you're, in fact, if you use something, even if you use like a fairly tough one, like a Kolmogorov-Smirnov, where you're looking at the maximum deviation in the CDFs. These things are all the same.
Perhaps there are many bubbles.
Maybe then you have this sort of fractal-like process, right? So I don't know. But the point here is that it's there's a very definite, easily sort of identifiable behavior to these drawdowns, and it's been fairly stable over nearly 200 years. And and I will tell you, if you look at other markets, you will find exactly the same thing. And if you look at other types of markets, not just equity markets, you will find exactly the same thing.
Okay.
All right, there's one more question. I don't want to. One second.
Last question.
To change the focus and look at the good news, so to speak,
Yeah.
as a complementary model or complementary problem, rather. The events, if we are sitting in very frequently in a state of depression, right?
Well, drawdown, not depression.
Yeah.
Okay.
So the good news, or spikes or bubbles, will be really extreme events, and statistics might be more interesting Because it seems that you're, with normal, even with normal, you can explain a lot, right? You don't need even to go to alpha stable.
No.
But
Normal
it was
doesn't.
the slide where
No. Actually, I think the difference was that with the normal distribution, the distributions of these drawdowns is exponential, which is not fat. I mean, it's just not very well behaved, nice furry distribution. It's very good. But yeah, it's memoryless, right? Right, it's memoryless, right? That's correct, exactly. So, whereas the if you look at the real markets, they have Pareto distribution, and they have quite fat tails. I mean, those exponents were between 1.6 and 2.3, and those are relatively low exponents, and that means you have some fairly fat tails.
Yeah, but positive news, it might be even more vivid, the fat tails of distribution. This is really extreme events.
Right, but I guess what I'm saying is, though, the things that we have to be, when we talk about what may happen, we have to be prepared for what, there's pretty good solid evidence that what may happen is pretty big. I mean, it's and I think we tend to, first of all, I think there's really 2 points here. One is that in order to gain some insight, you have to look back over as long a period of time as possible. Two, it is surprising that many things you look at, you can go back 200 years and find the data is completely relevant. It's very important to understand that. And the third thing is, when you do that and you are successful, because it isn't always true that you can go back all this time, but when you can do that, you find some very surprising things about the world. And in finance, it's usually that we live in a fat-tailed world in finance.
Okay. So, let's thank Dr. Frey for a very stimulating.